Well, good afternoon, everybody. Good afternoon, investors. Welcome to our April 15th. It is tax day edition of Bull Sessions. And yes, I did send in my federal return this morning, Ken. It has been ready for a few weeks, but I refuse to give them their money even one day early.
Oh,
And
you had to pay something, huh?
I did, and you'll appreciate this, I had substantial capital gains. And I don't mind paying them.
Yeah.
And so it wasn't that big of a deal. You may remember that I bought and sold Western Alliance pretty quickly, a
Well,
little over a year ago.
I paid a lot of taxes this year, including substantial capital gains, but my estimated taxes brought me to within $200 both on my state taxes and on my federal taxes. So I was very pleased with coming so close this year with my estimation of what I was going to have to pay to Uncle Sam. So.
And if you're joining us for the first time, or if you're just coming back, that voice that you're hearing is the magical mathematician who's better at math than me because he balanced his taxes ahead of time, Ken Kabula. Good stuff. All right. And we're also joined here. Kim is unable to join us, but we'll just simply nod in her direction and wish her well as she takes care of some business. And Matt Spielman is here today. Good afternoon, Matt.
Good afternoon, Mark. Good afternoon, everyone.
We're going to have some fun. We're going to talk a
All of
little
a sudden,
bit.
before you ask.
What are you rubbing in the weather? Because we had snow for a while here today.
Yeah, that variety. I miss that seasonal variety so much, but Julie, not at all.
There are times when we don't miss it at all and we live it. All right, so we're just going to take care of a couple of items of business. Got a few topics that'll just kind of flow and kind of potpourri type thing. Not too many of the mailbag questions, but we will get to that at a future session. But let's go ahead and get underway. We are going to talk a little bit more about that cash flow stuff. Here's your weekly reminder that Portillo's is not a sponsor of this session, although they should be. And I got to tell you guys, I get something almost every day from one of you. These are 4 separate emails that people sent me from the sign that is somewhere in the Matt Spielman neighborhood down in Fort Worth along the roadside. Chocolate cake donuts. Somebody accused me of writing that article for Barron's on the right there. And apparently these kits are the latest rage, and we've got that. So again, on the right, we've had about a 20% rally in Portillo's since the last time Kevin Gologly badmouthed it. So cooking along pretty well.
Phil Fisher would be jealous of your scuttlebutt, your extensive network.
And what's your basis in Portillo's again, Mark?
I don't remember.
Oh, all right.
I don't recall. All right, what I do recall is this is our standard disclaimer. No investment recommendation is intended. This session is entirely about really cool things that we have noticed over the years and a little exploration that we're doing along the way to talk about the methods, techniques, and philosophies of the modern investment club movement. Bit of a misnomer because it really is about the discovery of opportunities and the analysis of stocks and the construction of successful portfolios. So we're basically going to share some insights and some thoughts about that. You are reminded that you absolutely must do your own homework before making any investment decision. And don't you dare try to blame Ken Kovula for something that goes bad. So it's just will not, it won't make you feel any better, and he just gets mad. So don't do that. So if we do hold something in our personal portfolios, we'll try to remember to admit that. No, it doesn't happen all the time, but we generally do remember. But please, we know that you're here. You're not an average investor because you're here, and make your own decisions about the resources that serve you best. And we are certainly not the boss of you. If you'd like copies of these slides, we are going to have some very crowded slides on today's presentation, and we're kind of setting up to show some cash flow based screening. So some of them are busy. If you would like copies of the slides, or if you have follow-up questions or suggestions for future topics, we've got a couple in the hopper already. Send an email to either Ken or me at the 2 email addresses shown. Anything else, sir?
No, I think we're well underway. Let's start talking, Mark.
And folks, he's not mad, he's giddy. All right. What's going on? The Masters. If you had a chance to watch it, it was probably one of the more spectacular golf afternoons that I can remember in a long time as Rory came back to win. And of course, the tariffs are going on. Matt has been conducting some discussions in the Manifest Forum on that, so we'll talk a little bit about tariffs. But yeah, it's a roller coaster out there. It is tax day, hence the Reaper. And, how can you have the Masters without Susan Sarandon and Kevin Costner? The answer is you can't. It's just, although the picture is from Bull Durham, but we have crossover functions here. And all right, and the Charlie Munger code is going to be what we talk about when it comes to cash flow. Any thoughts, questions, comments?
I think Charlie has said it all. We can eliminate about 37 minutes of the program today and just listen to that one quote, Mark. All
Okay,
right.
done. When we get there, we'll just say we're done. All right. How about this, Ken, for a little excitement? You no longer have to squint to see the white space.
No, it's there definitely. But I'm glad that you made the point before the session, and we should make the point during the session, the same point you made in the green room, Mark. Why don't you tell them one of the reasons that 75% is sitting there right now?
I think that is a good idea. The 75%, you got to keep in mind that Value Line runs about a week behind. So when they publish something on April 11th, it's actually more like April 4th. So what you see happening here is the market actually recovered from the bottom of that trough. This actually catches that trough at right at that moment. But at the same time, notice that if you go back to 21, 22, we had an increase in the Value Line return forecast that was actually steeper and bigger. So it's not unprecedented, obviously with COVID and back in 2008, but yeah, absolutely. What else would you like to add, Ken?
Well, just making the point, I think that the numbers that are collected are at different points in time proves a more of a backward-looking number because the data comes from history, and my part is a very current number. Going back to the last day of trading, and now we know that Value Line might be as much as a week or maybe even a little bit more old with the data that they have to use to put their number together. So the fact that they don't join at the hip is understandable, and with the markets, with the volatility we've seen in the last 10 days, the fact that this goes from 10 to 15 doesn't bother me as much as it might if the market had been pretty steady.
Yeah, absolutely. And we do keep making the point. We'll spend a little bit of time on this. The prove, I think, is more grounded, more stable. I mean, it's a function of the overall capital structure of the company. It's kind of like the price of your house doesn't move around that much. It moves around every day. You just can't see it. But that's kind of what the prove is too, because you've got the total capital structure influencing that number. I would say even calming things down, whereas the other ones are going to move a little bit more with prices.
And we're not getting weekly data that shows the difference in things like long-term debt or liabilities or anything like that. We normally get data that's reported maybe 4 times a year. So there's a reason why Prove is much more stable than the other two numbers.
Absolutely.
Yeah.
And we think Mr. Buffett's right. Be careful about selling just simply on price declines. Although I will confess I had to sell a stock to pay my capital gains yesterday, and I had to pick out a couple that were I had to offset some gains with some losses, and you know how that goes. All right, here's the groundhog standings. It's the top 50. I switched it to the top 50 because it's a much bigger contest this year. It's 205 entries. For those of you wondering, I am sub 200. I'm at 201 or 202. So I'm grateful to the people that are still providing me some cushion. It's only a couple of you. But expanded the list of 50. Plus, we wanted to get Steve on the list at 50. Keep him optimistic. But the average groundhog, you can see a pretty good week. We went from minus 19 and a half to minus 14 for the average groundhog. 33% of you are beating the market, but the market's only at 11.2, so it's kind of a left-handed compliment. The value line arithmetic average continues to lag. I just can't believe that this persists as long as it has. But that's a full 3.7 behind the Wilshire. And yeah, the monkey's 50 points ahead of 50 places ahead of me.
Yeah, you've been telling us, Mark, there's a bunch of clubs in that 41 through 50 range, and here's the proof to the pudding. There's 5 clubs of those 10 entries right there. So maybe we'll see a movement. Our high this year for clubs in the top 40 is still up around, I think it's 12. But we have a number of clubs that maybe are going to be able to push up there. I wanna mention the 2 guys in my investment club that are in the top 20. My grandson in 3rd place, and Don Sheets in 15th place. So I will hear about this when the Wolves next meet. We didn't hit 12 this year yet, Mark. Our top number of clubs is 11, and we hit that back at the end of March.
That's right.
So we'll have to help these clubs get a little bit up the list here, or hope that they get up a little bit up the list. We have some really great clubs in that group through 41 through 50, including the broad assets down there.
A lot of very familiar names on the list. Kurt Kowitz, by the way, it's Kurt's birthday today, so if you want to send him a birthday note, Kurt K at manifestinvesting.com. And it's also Marty Eckerly's birthday. He's been on this list, but I think he just slipped off the list. So happy birthday, Kurt and Marty. Anything else here?
Well, it's just amazing the familiar names that are on the list, Mark. I mean, there has to be something to what we do for these kind of names to keep appearing, time after time after time. So congratulations if you're in the top 50, and let's all hope that we can move past the $1 million mark again. There's only 5 of us right now above there, and that includes 2 clubs. So
that Four Corners Club continues to blaze, Ken.
Yeah,
All right,
it does.
just a quick look, just a weekly reminder, and again, this is just simply the what is possible slide. Again, the top 10 or the 10 stocks listed are the 10 most widely followed. They do add up to that return that is boosted a little bit by NVIDIA, maybe more than a little bit. But again, that's a pretty good collection of stocks. Many of you in the audience own several of those. And we also point that the demonstrations are up there with those companies. And this is Index Central. And again, not wrong to be investing in that, but we think that it is possible to identify excellent companies and buy them when they're on sale. It's even more fun when you do it with friends.
Yeah, and it's not an index, Mark, but I think it is pointing out the strength in the last 10 years of the QQQ.
Yeah.
You have to tip your hat to a really pretty easy investment in the triple Qs, and to see how well it's done over the last 10 years makes me wonder why I didn't put 25% of my portfolio into triple Qs 10 years ago and just sit on it,
Yeah, my dad had a large amount in Vanguard Growth and VGT, which is Vanguard Technology, and VGT has actually kept up pretty well with QQQ, and his numbers were getting larger and larger with each passing year. It was kind of fun. Good stuff. All right, here's a contribution from Eddie Elfenbein. I think Matt may have sent this to me. It really demonstrates the volatility. Those 5 days on the right-hand side of this daily chart, I mean, those bars are all over the place. And some of those days included some of the largest price moves within a 30 or 45-minute time frame, I think, that we've ever seen. So that just shows you that, yeah, we're down and things are in motion.
Mark, could we attribute a lot of that to algorithmic trading, do you think?
I think so. I mean, you have a lot of people blaming retail investors. Um, a lot of people blaming tariffs. There's just a whole lot of stuff going on.
I
There's
just
there's
don't
got to
think
be
the retail
some.
investor has enough, is quick enough to make some of the volatility occur. I just think that a lot of this has to do with machines that are picking up keywords or key phrases and executing a sell order, and then telling you that if you want to buy it back, you can go and think about it and buy it back later.
Yeah, I don't know. Matt, any thoughts on this? I mean, I noticed an incredible amount of put. Those are basically option bets against Nvidia here over the last couple of days. And I think some of that is definitely institutional driven.
Yeah, I've not seen any statistics. I'm sure they will come out. I do wonder, to your point, Ken, what would an individual trader contribute to this? It's also something for an institution or an algorithm to go hunting for stop losses. Because if you have a stop loss put in, people paying enough money for the data can see that in level 2 information. So with volatility that high, there may be people who set something a long time ago, or in the worst case, they got tripped up in it as well. And that's one way that cascades or flash crashes can happen too.
And
But I have no data to prove that. Just an idea.
the other thing when it comes to algorithms and wondering, Ken, I did see a note, and since it came yesterday during an up market, I'm not sure what it was talking about, but it did mention the death cross on the S&P 500.
Oh,
Maybe Len Douglas has something to say about that, but he did. I mean, that death cross is definitely driving some of the machine algorithms for sure. So I don't know exactly when that hit, but could be one of these 2 days here. I don't know.
Mark, this isn't a question that, oh, it disappeared. So maybe it was from you. Okay. I was seeing a red tick just way down in the field with, completely unrelated to everything else. And I was wondering what happened on that day back in December, but then it disappeared. So maybe you had it there. Maybe it was part of
Oh,
your pointer or something.
well, that was probably the day I bought Western Alliance when it was
All
down.
right.
No,
Could
just
be.
kidding. Just kidding. All right. All right. Well, Matt, this is from your investment club visit from last night, so I'll let you describe how this fits.
Yeah, originally from a stock up that Doug Gerlach gave on selling in 2021 that I liberally steal slides from, but just another anecdotal point of view from Peter Lynch, certainly someone that a lot of us look up to and is very compatible with our ways, but again, reinforcing an expectation in the type of business that we're about, around 55% success. The idea that small edge over time and lots of repetition can bring big results. And really, we started down that journey really with Joel Tillinghast, who was a protege of Peter Lynch's. So maybe it's a little bit of echoing, but we also have some statistical proof of that actually. The other part too that I think really is shown best of all by the roundtable summary slide with the overall relative return, as well as the Microsoft slide, is that second quote, right?
Sure.
How much can you lose? At most, if you're not leveraged, what you put in. Usually people, even if they're reluctant to sell, will get out before it's 100% loss. But what you can gain, as shown on the slides before with those top stocks, is perhaps infinite, if not thousands. And that kind of skewness is our house advantage. Playing the long game, being long-term investors, seeing that compounding and letting it happen is what turns what a lot of people think of as a marginal activity, or perhaps even a fool's errand, into something that's quite powerful and quite believable and repeatable by multiple people.
Cool. It's fun investing with your friends. We're better together. And so thanks for that, Matt. And thank you, Doug Gerlach, for.
I think, Matt, one of the most important things you just said was, and letting the compounding happen.
Yeah.
I think that's the one key that a lot of clubs that are trying to find a silver bullet forget, that sometimes you just have to be patient and let the compounding happen. I think that's really, I'm going to make a big slide on that somewhere and use it, Matt. Okay, I've officially taken it, Matt. Okay.
That's fine. It wasn't mine. It wasn't mine to hold on to. I will say, if you're looking at that, it's quite instructive. And I don't remember what it is. I don't know if you simply say most of his fortune or if it was really after the first billion, but Warren Buffett's made most of his money after his 50s.
Oh
Why?
yeah.
Because he's 90 something, so he's had that extra decades to compound. And looking at his personal fortune over time, it follows a familiar nonlinear compounding curve for sure.
Exponential stuff is cool. All right. I just thought this was interesting. It's from Ben Carlson over at Ritholtz, and coming up with a whole lot of reasons to sell here. It's a somewhat sarcastic slide, and some of you, if you're out there worried about us feverishly selling, apparently we've even had tantrums before. So yeah, there's very little new stuff in the market. The tariff stuff is just another one of these things, and I just I don't know about you, Ken, but I think there's a whole lot more reasons to buy than sell for me most of the time.
Well, I would have phrased the slide. There's always a reason to buy, because these kind of things that are on this list, most of them, when I look at them in the rearview mirror, I view them as opportunity. They weren't nearly as bad as everybody thought they were going to be, and they've presented opportunity to the long-term investor.
All right, I'll fix it for Ben.
All right.
There we go. We fix things on the fly here. All right. All right, here's a quick look. You've heard us talk about this in the past. Just thought we would check in on them. Value Line actually does on YouTube a series called One Stock to Buy. They do it once a month. It's generally around the middle of the third week of each month. You can see the dates there towards the end of the month. But that's the entire track record going back to August 2022. And you just get kind of a flavor there. We've talked about it in the past. We were just hopeful that they were having a real sluggish period in here as they were wading through this area, and we actually wished out loud that they would buy some double-digit growth stocks, and they did, and that hasn't hurt them a bit in their overall portfolio. But this portfolio, we actually do place a limit. Anytime the RSI hits 80, we do an auto sell just to kind of keep track and keep some weeding. So basically capturing some overbought opportunities um, along the way. So the ones in yellow shading are positions that were closed out because of that RSI. Now, the thing I find interesting, this is a comparison of that previous page with the selling on the left and the numbers on the left updated by a week. And this is the answer to the question, what if we hadn't sold? What if we hadn't sold those highlighted fields? And you can see the 3.2 actually shrinks to 0.7. And anytime we have run this type of an experiment or demonstration, we generally end up with, when you take a sell discipline and you look at it, with a pretty good chance that you're going to run into a 2 or 2.5% difference. That's percentage points. And well, it's kind of shaken out at least so far. What do you see here, Ken? How do you like their picks?
I I'm not a big fan of the methodology. I don't know if there is a methodology, Mark. I think there's a committee that goes and decides that's going to be the stock they're going to deal with then. And I've I don't think this is any better or any worse than any other list that you read from any other commercial source. You see a lot of those lists at the end of the fiscal year all the time, and you hear hot stocks for the next year, that kind of stuff. And this is basically a hot stock for the next one a month for us here. And they certainly haven't had a really good track record in the last year. The annualized total return is, if I just go down for the 5 stocks and then down into the 24 stocks, there's an awful lot of red in that column. You know, in that first column, the annualized total return. Let alone the fact that the benchmark is negative in a lot of places, which I guess influences the total return. But those relative returns aren't something that I would be proud of in a portfolio that I was putting together.
Yeah, it's still a work in progress. It's just a few years. We'll keep watching. At times I've thought if we would go in and either bless or name something like a stock to study or an undervalued and classify them into different baskets, never mind. That's too much work.
Yeah, it is.
All right, here's Matt's slide, and plus it's got a good chuckle out of Ken on this one. Um, for those of you that haven't seen it, that's Nate Bargatze. He's a clean comedian. If you like clean comedy, he is awesome. But we've been talking about tariffs a little bit. Matt is covering it in much more depth in the Manifest Investing forum. But this is kind of my attitude. The skit itself, he was talking about things like why do we measure things in feet and yards and various units of measure, and every time he would ask a question, somebody would ask why do we do that, and he would answer nobody knows. So I thought it fit pretty well with the tariffs because I think the current situation. I read all these analyses. I think I pointed out there's like 4,000 articles on Wall Street Journal on the Wall Street Journal on tariffs when you do a search. Anybody who's writing stuff about specific impacts right now, and I'll use the phrase again, Ken, and then you can beat me up. It's clearly a work in progress.
I
That's
did.
true, Mark. As much as I've thought about it, I don't know what's going on either. But you know, it's certainly more important for me to see and understand when entities, or that be governments or companies, take action as opposed to talk about things. There's a lot of possibilities, and if there's anything we've learned is that what you start with may not be what you end up with. And so I do see, for example, the auto industry. A number of actors in the auto industry have taken specific actions, either halting or pausing sales, talking about moving production, halting plants for a while. Some of those are reversible. They're simply some weeks off or time to make use of it and do model changeovers. You know, but that was an industry very hard hit in the pandemic. And so I do worry about them sort of being a little reactionary. But I also wonder, or I'll be interested to see if there's a general consensus coming out of comments of the earnings calls in the next few weeks about what CEOs and CFOs really say they're doing, and if they're even pressed at that by the analysts at this time.
Yeah. Well, we know they're going to blame tariffs if their results are weak. They're also going to blame the weather, and that usually gets Ken up into a riled state. Yeah, I just simply go back to nobody really knows where all this stuff is going to end up, and I did make one speculative trade on the basis of when the semiconductors all fell off the cliff because of tariffs, and then I personally believe that we're not going to mess with the supply chain on semiconductors, not in a significant or material way. So I was trying to basically get rich so I could buy us all an island on that single transaction, and it hasn't worked out yet.
Mark, I'm going to ask you to back up one slide because one of our audience members has made a very interesting point about the value line companies. Steve Emmerich from Heart of Illinois has made the point that there is in fact a set of criteria that they use to provide the name of the stock of the month or the stock that they're choosing. And he's wondering out loud whether that has a lot to do with maybe certain flaws in this relatively short-term rating system that Value Line uses. Remember that Value Line, rates things 1, 2, 3, 4, 5, and that's not a 3 to 5 year future rating. That's more like a 6 to 12 month rating out in the future. And yet the picking stock that they're using is based a lot on the timeliness along with the safety and everything else of the stock.
Mhm.
So I think that's a really good point that we should make in order to be fair to what Value Line is doing.
Yeah, we shouldn't. Yeah, we were a little bit rough on them. They actually do a screening. They demonstrate their screener and they end up with a stock. But I will agree that some of the stuff does seem to be fairly short term. And I'll tell you the research we have done on anybody that tries to predict 1 year out for a stock, it just doesn't work for anybody. And it's actually easier to do a 5 year forecast than a 1 year forecast in terms of accuracy. So yeah, that could skew them or screw them up, for sure.
Yeah, I just thought that it was interesting, and I would balance the coverage that we gave to this particular topic just a little bit by mentioning that they are using an algorithm. It's not just random stock picking, and
No.
it has a lot of dependence on the Value Line rating system when they do that choice.
Yeah, and again, don't take my remarks as dismissive or disrespectful. I have an immense amount of respect and admiration for the Value Line team, for sure.
Well, and they still stay on my trusted sources list, so
Hmm.
I'm not going to stop using it.
All right, we'll
And
leave
Mark,
the.
one other question, since we went back to that slide anyway. Nick
Okay.
asked, you mentioned that you were using RSI as a sell criteria.
Yep.
And Nick asks, which RSI is that? If that's the default settings from stockcharts.com.
Yeah, it's RSI 14 default for sure. Because I don't have enough hours in the day to play around with anything different.
But
Okay.
specifically, it's not your long-term RSI that you've looked for.
No, it's not
before.
it's not the long-term one. No.
Yep. Thank you.
All right, so let's move on. This also is related to tariffs. So another slide that Matt shared with us. And
Now, this is the Department of Treasury's view, looking to refute a bit of the idea that China is manipulating this market. I will say, and I got the number after we talked about it in the green room. Let me see what it is. The Council of Foreign Relations estimates that China actually owns about 1.2 billion of U.S. Treasury securities. One source specifically mentions Belgium, that some of that is held through entities in Belgium. It wouldn't surprise me if the Cayman Islands is in there as well. Obviously, if you add those together, that's not just China. A lot of people hold money in that place, but we have an idea. I do know for sure too, speaking directly held in China, the amount of debt that China has held in the U.S. peaked in about 2014.
right.
So there was a lot of stories about it, and we have an idea in our mind, and that might be 10 years out of date.
Yeah, it's lingering for sure.
And overall, the total of that, as you grab it, because that isn't necessarily everything else, is slightly under a quarter of U.S. Treasury debt is held in foreign entities.
Okay.
To give the argument a little bit of context, what we were talking about prior to the program was, is some of the hair pulling really true about the fact that China can sink the entire idea of the United States being the reserve currency, and can they cause us all kinds of issues by selling all of their treasuries? And I think that the people on television are giving the impression that China owns a lot more in the treasury market than the actual statistics indicate that they do. It's still a lot. I mean, there's no doubt about that, but you can see that a lot of the treasuries are owned domestically, so that it's not that I don't worry about China using it as a tool to hurt the United States, but at the same time, it doesn't appear to be as potent a weapon as some people I think are making it. That's a very personal opinion.
Yep.
It
Yeah.
it
Go
kind of
ahead.
makes me chuckle. Maybe you're going right there too, Mark. Think Warren Buffett's 300 billion in cash is in this list too. Maybe that's insurance companies, and that might be a majority then, or
Yeah.
maybe it's other domestic.
Yeah. And as we talked earlier, the pension funds are about $1 trillion. And, up here in the mutual funds, if you talk about retirement accounts and the what is now a prevalence of target date funds, that's a whole lot of probably as much as a third to as much as 50% of that bar is domestic retirement accounts. So yeah, there's a bunch held in places other than China. All right. All right, let's go back and revisit just real quickly the theme that we talked about last week. The idea is to invest regularly and keep your PARs up. And a week ago, we actually had improved the overall projected annual return on the portfolio to 18.4. At that time, the future value of that would have been about $8,400. Well, we picked up some value from 3,600 down to 3,700. The par went down a little bit, and these two numbers are pretty much very similar. So still in the same ballpark. So we just thought it'd be kind of fun to track this over time, just for a while until we get tired of it. And the whole idea is to, again, invest regularly, keep your pars up, and grow this. Any questions or comments, Ken?
None at all. And I think this would be the kind of chart that would make more sense than some of the algorithms I watch clubs collect and monitor. At least this chart focuses on what probably is some of the more important values in the portfolio, and that's the potential annualized return. And of course, you don't have to use somebody else's numbers. You can create your own par for your portfolio if you choose to by just doing stock selection guides or any other kind of analysis. But this chart, I think, would have value and like I said, maybe more value than a lot of charts I've watched as I visited clubs in the last 30 years.
All right, let's have some fun. All right, so here's the topic we kicked off last week, and this is our friend Charlie. I guess it's Ghost of Charlie now, or Angel. Let's think of him as an angel. And this particular tweet, are we still calling them tweets? Are they X eats or something like that off of X? Well, this is by Finn Chatio on Twitter, now known as X, and actually walked through 10 companies, starting with Apple, and just basically made the insinuation that their long-term free cash flow per share compound annual growth rate resembled the stock price compound annual growth rate. Here are the 10 companies. And Ken's parting words last week were, I like it, but Mark, that's only 10 companies, sample size. So I went out and got another basically 200 companies to continue the effort to, in an attempt to keep Ken from getting angry. So
I I seem to be the reason for a lot of the activity today. I don't know. Okay.
you're an inspiration. Well,
Yeah.
anyhow, again, if we take what Charlie is talking about at face value, this is for a bunch of companies, and this is for a 10-year period from 2015 through 2024. That's what these two columns are. And if you basically take the average, again, I think it's a median, but averages can lie. But these numbers do resemble each other. So, I'm tending to think of Charlie thinking of the cash flow growth as a metric or a gauge of how the business is doing, and then the stock price or the total return, they are at least so far running together. And then we went one step further and said, okay, could we not take that, if that is something we can have some confidence in, maybe we should be paying some attention to the projected cash flow growth a little bit more than we have. So again, this is a thought experiment. I don't know where this is going to end up, but is it legitimate logic so far, Ken? Do I pass
Well,
any
well, the
Socratic method?
logic the logic's all there. And I think what legitimizes it, Mark, is the fact that one of our favorite sources, and we're going back to Value Line again, but one of our favorite sources bases their entire analysis on cash flow.
Mm-hmm. We'll be
So,
looking deeper at that too.
there has to be something to the whole concept of watching cash flow. I mean, if you weren't with us last week, we remarked that there's some very decent symmetry between some of these numbers, but there's others where you scratch your head and you wonder what's going on. Apple and Adobe, for example, you're at 2-to-1 in opposite directions on those two. So as we begin to study this, I think I'm not going out on a limb when I say, Mark, that you began the work on Prove to help us validate what we did traditionally in potential annualized return, PAR. And now this might give us a second way to validate a study. And the more ways that we can validate the studies that we do, the more confidence I think we have in our analysis in the first place.
What a nice segue. Keep going.
Well, Mark's using a three-legged stool to demonstrate that perhaps if these three values kind of sync up with each other and move in tandem with each other, then when there's a significant variance between them, we should be looking more carefully at all three of the values, because if we believe that they're moving in tandem, then when they don't move in tandem, that's telling us that somewhere, somehow in one of our assumptions with one of the three numbers, we've made an error. And we're looking very carefully at a lot of things. And I think even in this very tentative beginning movement towards giving cash flow a little bit elevated place in our system, I think we've already discovered that it acts a lot like some of the other numbers that we're very used to analyzing, like sales and earnings, and you have to pay attention. You have to use your noggin. You can't just do an algorithm and say the number's here and then it's there and therefore here's the growth. You just can't do it that way. Yep. Because these numbers come from reality, and reality is very rude to analysis sometimes.
Yeah, so we're probably, more than probably, we're going to dig in and talk about how we've used the projected return on value to moderate or basically adjust PEs up or down from a judgment standpoint. So these two working together, and all we're talking about doing is adding this third. So we will be basically building a workshop or some type of thing if this all begins to make some sense to us and we find it to be useful. One of the things that we wondered about, I asked the question of a couple of people, and Matt came through with the entry on the left. That slide is actually from the Value Line screener, where he went to projections, cash flow projections for their long-term 3 to 5 year growth rate, and just said, if Charlie is right, that should generate some companies that have some considerable strength going forward. And then I asked Matt to limit it to just the B pluses and above, just to keep some of the more chaotic stuff out of there. So, legitimate thought or not, Ken or Matt, what do you guys think?
I think it's very interesting. We have Nick out in the audience making a very interesting point, Mark, that PAR is always forward-looking based on forecast. Prove is always a little bit backward-looking based on actual data, based on numbers that have been reported. And cash flow, if we're going to use this as another forecast into the future kind of a number. So I think that if the three of them are beginning to line up for most companies, that's very interesting. And I think that's all we can say about it at this point. It's very interesting. We don't exactly have enough experience with it and enough data to say without a doubt that one follows the other, like you know, cows into a, well, I won't go to the slaughterhouse, I'll go somewhere else, but one does
Careful.
follow the other, you
We'll,
know.
we'll lose Steve Emmerich if you start butchering
Yeah.
cows. Um, yeah, I just think that this is a list of potential opportunity, and you see some of the comparisons on the right. I wanted to take a moment to explain the difference between a number like 75 and 17 and show you how that happens. So if you look down here at Shopify at the very bottom, their 3 to 5 year cash flow projections 25%. If you look at our calculated method, it's 15.7. Let me explain how that happens. These are the numbers for Shopify, so it's off by a little bit. I can't explain why one's 25 and one's 24, but that's their data. What they do for this calculation, and it's very robotic, they basically take the average of the numbers 22 through 24. So they average these numbers and then they compare it versus the number out here on the far right. So this average is then basically adjusted for the time value of money, and they calculate this growth rate. The problem is if you have any anomaly in the three numbers that make up the average, you see here this 11 is a little bit low when you compare it versus the other numbers in the thread. You know, it was a break. Okay. Same thing can happen in the opposite direction. If you had a very large number here, it begins to do all kinds of distortions to this number. Okay. So the way that we make that better is we take these same numbers, couple actuals, a couple of the forecasted numbers, and we do the same type of regression analysis that you use in a visual analysis on a stock selection guide. And so when you actually do that for the numbers in the red circle, you get this 15.7. We think that is a more useful number or a more useful characterization of this item. So that's why you see the 15.7 here for Shopify. Okay.
It may be a
Next.
slight digression, Mark, but Jennifer Birch from Houston will not forgive me if I don't take a moment.
Oh,
For those of you who use the other items in that box, revenues and earnings, understand that those are subject to the same issues that this is, right?
absolutely.
That's a condition of the mechanism, not anything cash flow specific. So be careful if you go to the shortcut or we're taught to look left. That's fine as a place to start, but you can get yourself crosswise, and particularly if you know better, if you're sophisticated enough to put the numbers from the statistical array into your SSG as projected numbers, you can do a lot better.
Excellent
It's
point.
also, since Matt's making the point about this annual rates box, Mark, why don't you circle that per share up in the upper
Absolutely.
left-hand corner there too, because a significant change in share number can also throw a monkey wrench into some of these numbers here. So we can't just say that this is the revenue number 3 to 5 years out in Value Line's opinion. This is a number that has we don't want to say problems. It just has data data things that go with it that make it sometimes a little bit less front and center as we might like it to be. I also want to point out, Mark, that in 2022 that was COVID and that was easily understood, but
Mm-hmm.
cash flow also has the ability to move around quite a bit if a company makes a very large acquisition or a very large merger. Cash flow has can move around significantly out of trend on a year when something like that might happen. So it's not going to just be a macroeconomic thing that will take and give you an outlier in a cash flow set of numbers, but it might be something very company specific that gives you that outlier to deal with.
So when I continued down this path of looking at these cash flow growth numbers, I was careful to avoid COVID. So most of the analysis on these companies is going to be done using this time period that you see in the red circle. And that's because the COVID was a nightmare in terms of the disruption. Now, for some companies, it makes sense to go back here and go back pre-COVID, maybe start here or start back here, but never start a regression in here. It will mess you up more often than not. Don't start your regression. And again, a lot of times Wall Street will pick those starting points to make a point. All right.
And we can confuse the audience even more by indicating that if a company has a really odd fiscal year, and there's a lot of them out there that do, then COVID doesn't occur in 21, 22. It a lot of times occurs in 22, 23, as far as the reporting is concerned.
Yep. And there may be
It
some.
didn't change. It didn't change in reality, but it changed as far as the fiscal year number is when you have an odd fiscal year to begin with.
Yep. So some thought has to go into it. So that's just for future purposes. So here's the current list. This is a partial sample of the value line 1700. So keep in mind that it's still a work in progress and it's preliminary. But I do like what I'm seeing in terms of unearthing, potentially interesting studies. Like I am really interested in like Mercado Libre, for example. It's one that we've talked about a lot in the past, showing a lot of strength here with the 25, and then these numbers are slightly less. So as I study this company, I'm going to be asking the question, well, maybe the PEs could be a little more generous, or maybe like Nick DiVirgilio pointed out, in the proof calculation, you're using the operating margin. So when these numbers are a little bit low in the right-hand column, you can ask questions and do some head scratching over the operating margin, which basically determines projected operating margin, determines the numerator in that calculation. So
And I'm going to go one step more with a company like Mercado Libre, Mark, because I'm in a club that owns it. And I'm going to suggest also that the value of the Argentinian peso probably plays in to the cash flow number a lot more than it might play in to some of the other values for the company. This is not a company that deals with dollars a lot of times. It's an Argentinian company. So I'm just throwing that out there. I think that will play into that number. I really do.
now you've given me a currency migraine, but okay. Hey, and I do think that the one that Matt has talked about here, this Warby Parker, I actually ran some numbers on it. I think it starts to become very attractive at 12 or $13 a share. And again, same question. I would like to understand, maybe the PEs are a little bit more punishing than they should be, and what's going on here. And
Now we need to declare this is an early stage company.
early stage company.
If not for the shenanigans this quarter, this might be the year that they're launchpad, just turning into GAAP profitable from other things. But I think it's just interesting that it's measurable from projected cash flow growth. So clearly they have cash. They're still investing quite a bit in their business, and the rest of it you can look up in the forums.
I'm glad to hear another voice, Mark, singing the same song that I've been singing since you first started this discussion. I have some real problems with early stage companies and trying to come up with projected cash flow for those companies. So I'll just continue to state that every now and then. And Matt, you can continue to state it as well. Okay.
All right.
I do find it very interesting that Generac's on this list. I'm beginning to wonder if maybe it isn't time, or maybe it hasn't already been time to rake that one over the coals. But anyhow, I think it's an interesting list. I mean, I own a few of these, Eli Lilly being one, for sure, Chipotle, and I have owned Wolverine from time to time. So we'll continue to build out this list and see if it continues to be interesting and if it offers potential for some fun stuff. Here's a quick update I just thought I would show on Lulu. In the current update, from Value Line, it did get kind of cranked down a little bit. So I just want to warn everybody about that. And I also put all three legs of the stool here for now. so that you can look at all three of those numbers. But this is definitely a flattening trend that I think some people are legitimately concerned about. If you can make a case for that changing, it changes the analysis. But I do like the fact that these three numbers are basically singing a very similar song. But that does take a few percentage points off of our Lulu expectations, Ken, in the current update. Just a
At
couple.
the same time, Mark, for a company this size, 12% par is pretty
Oh,
decent. I
I'm
would
not.
take, you know, yeah.
I'm just saying that it's more likely that one's closer than an 18 or 20% par.
Oh,
So,
absolutely.
and so here's a little bit deeper look at the company. I also added the value line high total return forecast so that when you're looking over these reports that we regularly publish, you have this range. So if you're looking at 7 to 11, and again, I'm not saying value line's right all the time, but if you're if you've got 18 or 22 on your section 5 of your stock selection guide, yeah, maybe make a mental note that it's outside that range. And then last but not least, the rhinos still are extremely optimistic about Alta with that 54% price to fair value.
And Mark, you think it's fair to say of all the numbers we've talked about in the last 15 minutes, that's the one number that we have always kind of looked at with a little bit of skepticism?
Uh, I look at it with a healthy dose of optimism
All right.
as a healthy dose of optimism. And we'll talk
Okay.
about fair value probably next week. We have a couple questions from in the mailbag about what is fair value, so we'll tackle that. All right, so let's go ahead and call it a day. Here's a reminder that on YouTube, you just go to Manifest Investing, you can get previous sessions of the bull session or roundtables, and some of our educational sessions are there also. If you can't find them, send a note to Ken or myself. We did reschedule the event at the Rochester, Michigan Public Library to May 10th. So Ken and I will be having some fun there on a Saturday morning in a real face-to-face meeting, and we look forward to spending some good quality time with some really cool investors here in Southeast Michigan and Mid-Michigan. Yeah, you think maybe there might be a few Mid-Michigan people to sneak down here, Ken?
It's close enough, Mark. I think that you might get a few. Yeah.
Well,
Mark, can I make a point about an upcoming event as well?
absolutely.
I've noticed in our questions box this afternoon that a few of you are applauding the fact that the next roundtable is going to talk about ways to use AI in their stock research. And that's not a roundtable program. That's a ticker talk program. And I don't want you to come to the roundtable expecting something that's not going to be there at the end of this month. Our roundtable program is set for the last Tuesday in April.
Hmm.
That's April 29th, and it'll be a pretty traditional program. We are not going to be talking about using AI to research stocks, but the next ticker talk that's coming up, which will be a May ticker talk, tentatively set now for May 8th. That one will be talking about ways that you might begin to use some of the AI engines to do some basic stock research. So make sure that you get the names of the programs correct and that you're going to the program that you want to go to get the program you want to deal with. I would go to both of them. They're both going to be pretty decent
Hmm.
programs, but it's not going to be at the roundtable. The AI stuff is being done by Susie Artsberger, and that's in Ticker Talk.
Okay, we did talk about a case study or two, that machine learning, machine churning.
Oh, that'll
For
be that'll
for
be a
that,
lot different than actually teaching people how to
right,
use the research. Right. Uh-huh.
right. We're probably going to end up demonstrating where AI has led somebody down an overactive path would be the way
A
I would put it.
primrose path,
A
right?
primrose path. All right. Let's close with a look at the harbor in Chicago, the roller coaster, which is real. That's from the Motley Fool. And then, as I mentioned, Rory had an absolute roller coaster of a round on Sunday afternoon and still came out a winner with the green jacket. So we'll celebrate a little bit with Rory McIlroy.
And our Breakfast Club friend, Mr. Steve Emmerich, has his hand in the air. So, Steve, you're self-muted. If you unmute, we'll let you say a few words. Go ahead.
Okay, I'll keep it to a few. I would urge folks that are interested in AI to pay attention to Bakul's presentation from the Golden West chapter. It's coming up. The second one's going to be, or third one's going to be on Friday night. So check out the Golden West chapter's webpage. You'll see the recordings from the previous two under news and articles. Good stuff.
Yeah, in fact, Bakul
Thanks a lot for that.
He gave a presentation at your Breakfast Club that got a lot of this stuff kind of launched. All right.
Yeah, it's good stuff. I put the link in there to the Golden West chapter's local events in the questions box.
Okay. All right. Anything else, Ken?
No, it's a little bit after 3, and I'm ready to call it a day today and hope that we see people back here again next Tuesday at 2:00 in the afternoon.
All right. Good luck out there, everybody. Bring us your bargains and share your ideas, and Ken and I will steal them and turn them into capital gains. No, just kidding. Thanks, everybody. Good luck out there, and take care.